Why U.S. Treasury yields rose after the Fed cut interest rates. Last Wednesday, something unexpected happened in the world of finance. The Federal Reserve announced a 25 basis point interest rate cut. Normally, this would lead to lower U.S. Treasury yields, but instead, they rose. Yes, you heard that right. Treasury yields went up. A reaction that defies conventional wisdom. So what's behind this anomaly? Has the relationship between the Federal Reserve and Treasury yields changed forever? Here's what happened. On December 17th, the Federal Reserve made its move, cutting interest rates. But by December 18th, the 20-year Treasury yield had surged from 4.67% to 4.84%, breaking past the critical 4.8% threshold. This spike in yields caused Treasury prices to drop significantly. For example, the TLT, an ETF tracking long-term Treasury bonds, plummeted from $90.73 to $87.58 in just 2 days, a dramatic 3.5% decline. For the bond market, this qualifies as a major drop. Naturally, this raised a big question. Has the underlying logic of the Treasury market changed? Well, the truth is, the logic hasn't changed. What has shifted is the market's expectations about inflation. Let's break this down. When the Federal Reserve cuts rates, they're reducing the federal funds rate. Think of it as the interest rate for overnight lending between banks, the shortest term rate in the system. But here's the catch. Short-term rates and long-term rates don't always move in sync. Just because short-term rates drop doesn't mean long-term rates will follow. This time, the surge in yields reflects something bigger, a shift in how the market views future inflation risks. So what's next for Treasury yields? Only time and inflation will tell. Today, we're diving into a fascinating development in the world of finance. Why did U.S. Treasury yields rise after the Federal Reserve cut interest rates? To understand this, we first need to explore a theory introduced by former Federal Reserve Vice Chair Richard Clarida. It's called the Clarida Four-Factor Model, and it explains the 4 key factors that determine long-term interest rates. The first factor is short-term Treasury yields, which are linked to the federal funds rate. The second factor is term premiums, which reflect the price differences between interest rates of varying durations. The third factor is short-term inflation expectations. And the fourth factor is long-term inflation expectations. These 4 factors together shape the trajectory of long-term U.S. Treasury yields. Now, the most critical factor in play right now is inflation expectations. So why did U.S. Treasury yields rise after the Fed's recent rate cut? The answer lies in a shift in the market's inflation expectations. This shift started with comments from Federal Reserve Chair Jerome Powell. After the Federal Open Market Committee meeting, Powell stated that we're entering a new phase where more progress on inflation is needed. He also hinted that the pace of rate cuts might slow or even pause, suggesting that the path to future rate reductions in 2025 might not be as smooth as many had expected. This was reinforced by the Fed's updated dot plot, which showed that most policymakers now anticipate only 2 rate cuts in 2025, down from the previously projected 4. This signals a tightening of monetary policy. For the first time in recent meetings, Cleveland Fed President Loretta Mester cast a dissenting vote, opposing the rate cut. Mester argued that rates should remain steady until inflation has made more significant progress, expressing concerns about inflation possibly rebounding. So, what did the market take from all of this? A rising fear that inflation might come back. As a result, the Fed is slowing the pace of rate cuts, which suggests that rates might remain relatively high for the foreseeable future. In essence, keeping rates steady or pausing rate cuts is akin to tightening policy, acting like a rate hike. Historically, when the Fed tightens policy, Treasury yields rise and Treasury prices fall. This explains why Treasury yields surged after the rate cut. However, this spike only lasted 2 days. By Friday, Treasury yields started to decline, and prices began to recover. The 20-year Treasury yield dropped from 4.84% to 4.80%, while the TLT ETF price rebounded from $87.58 to $88.42. What caused this reversal? Well, the U.S. Department of Labor released inflation data for November, including the Personal Consumption Expenditures (PCE) price index, which the Fed watches closely. The PCE index rose by just 0.1%, lower than the expected 0.2%. This suggested that inflation might be under control. If inflation is being contained, the Fed could resume rate cuts to stimulate the economy, which is why Treasury prices rebounded. In summary, the recent fluctuations in the market were driven by inflation expectations. The Federal Reserve continues to monitor inflation and employment as it adjusts its monetary policy, and the market is responding to these signals. Despite the ups and downs, the core logic behind Treasury yields remains unchanged. Under this logic, what kind of trend will the U.S. Treasury market follow in 2025? To predict the trend of U.S. Treasury bonds in 2025, we need to start by looking at market expectations regarding inflation. First, let's discuss the Federal Reserve's monetary policy. The policy guidance from the 12-page report has already shown that the Fed has shifted from a hawkish to a dovish stance. This shift is beneficial for controlling inflation. So, based on this point alone, we can assume that the market is about to adopt the view that the Federal Reserve's monetary policy will tighten, leading to lower inflation. The second factor affecting inflation is the Trump trade. That is, the economic policies that President Trump will implement after taking office. After Trump was elected on November 6th, the core reason behind the rise in U.S. stocks and the decline in Treasury bonds was the so-called Trump trade. During his campaign, Trump advocated for several economic policies related to inflation in 3 areas: imposing higher tariffs, expelling illegal immigrants, large-scale fiscal spending. Let's start with tariffs. Trump proposed a 60% tariff on China and a 10% tariff on the rest of the world. He even said that he would impose a 25% tariff on Canada and Mexico. Trump is not a typical politician. He is a businessman. He's accustomed to using tactics, bluffing, and inflating things. Often, his rhetoric is louder than his actions. His goal before taking office was to set a high bar for negotiations so that when he sits down to talk, he has leverage and can demand more benefits. Don't expect Trump to actually impose a 60% tariff on Chinese products right after taking office. This is not going to happen. Tariffs will be raised, but it will be a gradual process. Trump is very aware of the domestic inflation situation and cannot impose such a drastic tariff hike all at once, as the U.S. market couldn't bear it. The second factor is expelling illegal immigrants. If these immigrants are driven out of the labor market, wages will rise due to the labor shortage, and with higher wages, inflation is likely to rebound. However, this is not that simple. The exact number of illegal immigrants in the U.S. is unknown. Some estimate 30 million, while others say 10 million. Let's take the smaller figure of 10 million. To deport all 10 million, the U.S. would need to spend a lot of manpower, resources, and financial costs. Moreover, the actual implementation of this policy is in the hands of state governments, especially those in Democratic-controlled states, which are not aligned with Trump's agenda. So, while Trump will attempt to expel illegal immigrants, it will not happen quickly or smoothly. How much of an impact this will have on the U.S. labor market is still uncertain. The market is watching closely because Trump will officially take office on January 20th. After he takes office, the question remains: what economic policies will he push forward? I estimate that within 1 or 2 months after taking office, the market will be able to clearly judge the direction of Trump's policies and how they align with the Fed's stance. In other words, by February or March of next year, the market will have a clear understanding of the future path of U.S. inflation. Only then will we see a true reversal in U.S. Treasury yields. Of course, we also cannot rule out the possibility that, for various reasons, the market may start pricing in these expectations ahead of time. This is my initial estimate and judgment of the U.S. Treasury market in 2025. I welcome discussions and exchanges on this topic.